Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, here we are, Jim, and it's been an interesting week in the markets.
Well, you said a few months ago March will be the make it or break it month. Is it?
Yeah, it is. We just go back a bit because when the pressures were on going into December 24th, our work in the summer had called for that if there was a liquidity problem, it would probably clear by Christmas, as late as Christmas, which it did do. So then we looked at the oversolds. Everything was oversold. And looked for a natural rebound and figured, okay, March could be it. You can often have a seasonal high for example, copper. Anyway, so we chose March and began to watch. The rally did very well, and it included our indicators with the yield curve, credit spreads, industrial commodities, which last year we called friends of the bull market. This year we were just calling them friends of the rally. And so they all worked out. Now, most of these things kind of reached momentum highs on January 21st, and then that turned out to be a high for a lot of things as well. And our technical stuff was coming in. We had overboughts, upside exhaustions, sequential sells, everything was coming in, and which we've been publishing. And then now the market is rolling over. The other one that was interesting within the stock market was the advanced decline lines on the New York Stock Exchange Composite. That's the big one. And it got hammered all the way down. It led last summer, I think. It led the top of the senior indexes, like the S&P, by about a month. And then it had its low on the advanced declines was December 24th with, a lot of other stuff. And then it was exceptional rally for the advanced declines. That's the number of stocks that are going up relative to the number that are going down. And that reached a high a couple of weeks ago. And now it's rolled over. It's heading down. But when this thing was rallying, and it made it to the advanced decline line, made it to higher than reached in August, with then, everything being up, so to speak. So this is really a lot of impetuous buying on the stock market, and that showed up in momentum, momentum measures, sentiment measures. Of course, valuations are high, and we were looking for the top, and as I phrased it, around March, and we can say it looks like it peaked in late February, close enough. But we were advising people to take advantage of another return, another chance to take some liquidity out of the market. So this is breaking down now. Industrial commodities are weakening a little. In the credit spreads have narrowed, which they were likely to, but they're now reversing and going the other way, having moved more recently too quickly. And then the other one is the yield curve, and it turned to a warning last summer, and then became overdone at Christmas time, and had a brief bit of flattening, and then now it's back on the trend to steepening in the yield curve is extending, and that is a negative for all of the financial markets. So it's Friday, Jim, but we haven't got a happy story today.
Maybe more of a reason to go out and drink?
Okay. But not until noon.
Well, of course. So if you're taking a look at this market as an investor, do you bail and hold on to cash? Or are there still some areas where there could be some growth?
Yeah, good question. The way we look at it is when you're in a bull market, you want to buy the dips and maybe take a little money off on extremely strong rallies. And then when you're tipping over, and that was the greatest bubble in history. So when it starts to tip over, you want, or as it starts to falter, you want to start selling the rallies. And this has been our advice, was to sell and build liquidity during the summer. And then in December, it was for traders to, that be prepared for a rally. And we're up here now, and the advice was to build some liquidity. This is good research, but it's not, you can never have perfect research. So the question now is that you had a very robust rally, and it generated outstanding technical excesses, but lower than the highs of last year. So what we wonder now is, will this be a correction in a much longer rally, or has this been a rebound within a bear market? And that will take some time to determine. And then the other thing, what we talked about, Jim, last summer, was that the ideal position for investor-type people, and that would be if you go to cash in the expectation of a declining market, that's sort of represented by T-bills. And T-bills in a contraction could go down to zero. So every rollover on some short-term instrument, you're going to get less yield. So you want to lock in some yield, and that can be done by, as we advised last summer, to buy good grade corporate bonds, because you'd get a better yield than buying government bonds. And then the term would be 3 to 4 years. So if you got quality corporate bonds, it reduces the risk. And then when you're shorter dated exposure at 3 to 4 years, that also reduces the risk, and you're going to get a better return out of going straight to cash or straight to gold. That's a different story. So the advice has actually been working out, and as I say, it's not known yet whether this decline now will go to new lows or not. It's I would have a guess on it that quite perhaps that after mid-year, that you've always got nice things can happen in May sort of thing. And then what our concern will be, as it was last year, was what happens after mid-year. And that was when we were talking about sunshine in the markets out to mid-year. Then in August, it may turn to the twilight. And then after that, the term we had fun with is that in the fall it could turn into the Twilight Zone, which was a scary TV series. And it did turn into, I'd say, about a three-quarter Twilight Zone. It was a heavy hit. Some senior high-flying stocks gave up 50, 60%. The senior indexes sold off 20%. So that sort of changed a lot of the magic in the markets. But we can always come up with some protective moves, and we can also come up with some opportunities as they appear ahead of us.
We'll have more with Bob Hoye right after this.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Welcome back. We're speaking with Bob Hoye. Bob, the central banks seem to have put their interest rate hikes on hold. Is this actually a case of they're doing it before a recession hits?
You know me on central banks.
Oh, I sure do.
They are rent seekers. They've found a way to get a degree that'll get them a cushy job. And they really believe that they're running things most of the time until they get whacked between the eyes by a 2x4 called or wielded by Mother Nature. So we looked at the history of short-dated interest rates. You got two kinds. One is the market rates of interest, like T-bill rates, 3-month bills, and they trade all of the time, changing in yield. Then you've got what the central banks have, which is the administered rates, such as the Fed funds rate or Bank of Canada rate. Generations ago, it was called the discount rate. And even before that, it was called the rediscount rate. So, hey, there's always a term. But history shows that at exciting times, like at the bottom of a market, when interest rates begin to change, or at the top of a market, there's another important change, and the central bank, the senior central bank, will be behind the market by a number of months. For example, in 1929, the U.S. Treasury bill rate went up until May, and it went up because of the boom. And then when it turned down in that fateful June of 1929, it was saying that the boom was beginning to cool. And yet in August, the Federal Reserve raised their discount rate to 6%. But as they announced this, it was designed to curb what they thought was excessive speculation in the New York Stock Exchange, but it was also, they had it set up so that it would provide more liquidity to Main Street. So the theme was they were going to kind of tighten up to Wall Street and ease to Main Street. Well, of course, it didn't work because you had built a bubble, and they frequently, or the great ones, have all crashed in the fall. So then in October, as the markets were failing, the Fed lowered the interest rates. So you went from, let's say, June to October, with the Fed being behind the market. And here we have, now at the moment, the T-bill rate in the U.S. is still up. And we've been watching it for it to turn down, and it hasn't turned down yet. But over in London, you have the London interbank rate, LIBOR, the 3 months, and it reached its high in the middle of December, and it's actually heading down now. It's declined and taken out some lines and things. So one could say that interest rates, as represented by LIBOR, are heading down, and that says that at least in Europe and London, perhaps the contraction has started. But here is one of the things that has been amazing that I've seen at market peaks, and definitely in 2007. And that peaked in the middle of October, and in September, I kept quotes on it where leading Wall Street spokespeople said not to worry because the Fed would cut rates. And the Fed, of course, would have perfect wisdom in knowing when to cut rates, and all would be well, stay long. Then you ended up in the worst financial calamity since the 1930s, and interest rates came down. So you've got people in Wall Street in high places with a theory that doesn't match with reality. Their theory is that in a crazy boom, all the Fed has to do is lower interest rates and the boom will keep going. But in history, and there's 300 years of it, the reality is that short-dated rates, such as Treasury bills, go up in the boom, down in the bust. So they've got cause and effect completely screwed up, and yet these people are in positions, high positions, where they have tremendous influence. But I must say that with this peaking market, which really you looked at the NYSE comp, it peaked in January, and then the S&P peaked in September. I haven't seen as many statements boasting that the Fed would prevent bad things, but was it 5 or 6 weeks ago, and relating to your question, Jim, is that then the buzz went through that there would be no more rate increases, and then that's what helped push this latest rally, which became quite impetuous. So yeah, we ended up with the notion that all is all right because the Fed's going to lower interest rates, and what's really going to happen is the stock market declines, and if it extends its decline, then the T-bill rate's going to go to zero again. So, and it'll be just another example of the central bankers being behind the markets, and yet the irony is that there's so many people write virtually every day, and it always is based upon, well, the Fed is going to do this or the Fed is going to do that. But I'll tell you one thing, Mother Nature and Mr. Market really does it to the senior central banks every time. And we're going to be, the next few months are going to be fascinating.
We'll have more with Bob Hoye right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, do you think the U.S. dollar is going to continue to climb?
Oh, yeah. Good question. We figured for the first quarter that the dollar index, the DX, would trade between 97 and 93. And I think the low was 94.5, and then 97.20 was a recent high. But now it's way beyond that. It's in just this week, it's had a nice move up. Now here's where the history comes in, is that in each financial bubble, the senior currency has gone down. It's lost purchasing power. Sometimes it can go down relative to other currencies and down relative to commodities and stocks. But in every case, once the bubble was over, the senior currency went up, and the senior currency is still the U.S. dollar. And the line that we've been using is that the dollar will become chronically firm against most other currencies and most commodities for most of the time. And this week's rise in the dollar index, as the markets have become nervous, is appropriate action. So once you get into a contraction, the Fed may wish to depreciate the currency, but it can't. The mechanism that we've found for it is that during the boom, a lot of corporations and countries with not terribly good credit ratings have no trouble raising loans through bonds in the financial center, which is New York. And then a lot of that new debt is written, contracts are due and payable in U.S. dollars. So effectively, the great debt bubble that goes with a stock bubble is essentially a short of the U.S. dollar. That sometime in the future, the borrowers, whether they're corporations or countries or provinces or states, they will have to get their hands on a dollar in order to meet their obligations in New York. It's like, it's sort of a mechanism, isn't it? So, yeah, this then becomes a problem, and in the 1930s, it prompted economists and central bankers to come out with all kinds of ideas to stop people from hoarding cash. That was a feature of the 1930s. So, the dollar index has built a good base. That was from January 2018 through, and built a good base. I think the low was 88, and then the breakout was at 90.5, and and reached a high in December as the financial pressures were maxing out. Had a correction in here now, but now it's taken out, or it's new highs, so it's back on the uptrend, and it is not the friend of the markets, and we'll just see how this works out.
Bob, thank you so much for chatting with us.
Good to be with you, Jim, and look forward to next week.
Our guest has been market historian Bob Hoye. He's the Chief Investment Strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of Howe Street Media Incorporated.